Why is it that some teenage girl in Florida is not allowed to buy OpenAI stock because she's not an accredited investor? And yet, in the infinite wisdom of our legally bribed politicians, she can buy Enron stock. What percentage of the money is going to these 30 firms? 30 firms, 90% of the money. One out of every $10 that is invested into a venture fund is going to one firm, Andreessen Horowitz. We've woken up to realizing we need nuclear power, we need energy to fuel the AI. We need to manufacture our own stuff and bring supply chains onshore.
What's next, Austin?
Austin went from have to move to Silicon Valley or New York or Boston to get funded to no, you could stay here and they want to invest in us here.
Ignite your curiosity with Austin Next. I explore how ecosystems are built and how tech shapes the future. Austin is the frontier. It's where innovation takes root and new myths are made. Join What's Next. Andrew, welcome to Austin Next.
Hey, Jason, great to be with you.
All right, so there's a couple of stats and some events I want to kind of throw out there and use those as a starting point to what's the state of venture capital today. So one, PitchBook put out some numbers recently that was 75% of all the LP dollars raised by VC funds, I think it was last year, was by 30 firms, with 10
I thought
of them.
It was 90%. I thought it was 90%.
It was getting
Are
up
you sure?
there. Like it was, and the 2025 might be something, but the point is we're heading, whether it's 75 or 90, it is overwhelmingly by like 10 to 30 firms because they're raising these kind of mega, funds. And then on the same time, you had Goldman buy Industry Ventures. So this kind of, okay, so now we're having VC firms being acquired. And then even like General Catalyst, there's all these kind of rumors about an IPO. So the nature of what VC firms are doing, at least on the big end, are starting to really change and maybe even turn into something new. What's going on? Are we seeing a barbell in this? How would you give the kind of the state of the VC world?
So our research, and anyone can pump this into ChatGPT and see what it spits out of saying, like, show me references from Kauffman Foundation, Cambridge Associates, PitchBook, CB Insights, blah, blah, blah. That's verifiable. What percentage of the money is going to these 30 firms? 30 firms, 90% of the money. That's what we're seeing. Mm-hmm. And 10%, so one out of every $10 that is invested into a venture fund is going to one firm, Andreessen Horowitz.
Right.
And I believe I speak to LPs, every week that beat their chests like Tarzan, bragging about how they just invested in Andreessen Horowitz. And I say, which fund? Are you in the Ecuador NFT fund or are you in the Silicon Valley AI fund? They often don't know. I'm like, dude, you're chief investment officer at a big multifamily office and you just made a big investment and you're not sure which fund it was. And I'm like, all right, well, no, I can figure that out. And I'm like, what was their DPI? What's the actual fund performance? DPI, IRR, TVPI, MOIC, whatever. And they don't know. But I'm like, get back to me on that. I mean, dig into the materials you found and like try and find it. And it's like, they talk a lot about what they do for these things. So it's pretty interesting that, so many VC funds and it's all the money's going to those. Then the next question is it venture capital? What is the size of the fund? And, how many investments do they make per fund? And what's the average check size? How much is going to primary? How much is going to secondary? At what stage? Like, are all the decisions at the startup already done and made and there's nothing left in strategy or, much to do? And it's just pre-IPO financing.
Just growth dollars to get to the next level.
And even like, when I started as an entrepreneur in the late 90s, you would IPO your company when you got to 200 million of revenue. I mean, there was a .com craze. You just add .com and you IPO and just rush the public markets for venture financing. But, typically companies went public at a certain point.
I mean,
now
we're hearing from
private forever.
Yeah, we're hearing from OpenAI. Well, so you have two things of that. So one, you have these companies like Stripe or Space that are staying private for, ever, and we're questioning whether they're ever going to go IPO. Versus OpenAI, this was what yesterday, or the day before, was talking about. We're thinking about going $1 trillion IPO. I'm like, okay, at that point, is all is it really getting out to the public markets, or is like all the runway been taken if we're doing $1 trillion IPO? And I think SpaceX would do the same thing.
And it asks a lot of other questions like, why is it that some teenage girl in Florida is not allowed to buy OpenAI stock because she's not an accredited investor? And yet, in the infinite wisdom of our legally bribed politicians, she can buy Enron stock,
Mhm.
which is a Ponzi scheme, and they should all go to jail and commit suicide. So, what is, the whole system is really screwed up here. But I think that the two big changes kind of during my career in venture, and I've been in venture as a founder or investment banker or running an angel group and running VC funds and running venture capital equity exchange funds pretty much my entire career since the 90s. And the big changes are a VC fund in the 90s that was 50 million in size. They would basically deploy that money over 2-3 years. Actually, back then they would deploy the money maybe even over 6 years, where the commitment investment period is like legally 6, but they deploy it all in 3.
Sure.
And so they raise a new fund every 3 years. That $50 million fund, if they haven't, given up and shut down, if it's still going, would be minimum 750 million now. And if it was a 150, 250, 350 million fund, which is how big NEA was then, NEA's latest fund is 6.8 billion, with half of that as a seed fund and half of it as a CV continuity vehicle, where they haven't had exits. Everything's staying private forever. So instead of getting bent over a barrel and selling all their assets to Hans Swindlen from Industry Ventures as an end of life solution with a discount to the share price that they've invested at. So if you're holding the asset and you hit year 12, you either keep going to year 14, and we saw that happen.
Right.
Companies going to year 16 with LP consent after year 12. And then they said, well, you just got to sell this. And so somebody's like sharpening the knife, like, all right, you're almost at year 14 now, time to sell. You're not going to get LP consent to keep going. You're tired of doing these K1s. You want to put a bullet in this thing. Sell to me at a discount. Okay. I'm not giving you fair market value for that if you want to sell to the Grim Reaper secondary thing. So NEA is so big, they're like, I'm tired of that. We're raising our own CV. We're going to buy from ourselves. And so they offer the LPs in that fund the option just to roll into the CV or take the distribution at a fair, amount, fair pricing. So fund that was, 50, now 750. Fund that was 250, 350, now multi-billion in size. Imagine you and me have to deploy $1 billion in 24 months. Even if you make a 500K investment with Peter Thiel into Facebook at seed, and that thing makes, 1,000x return, it's going to be washed away by another $999.5 million that you invested in growth. So that's like fund size. So when you see all these dollars going to 30 firms and 10% of it all goes to Andreessen Horowitz, they're forced to put the money into companies that have like 25 million in revenue to justify a 225 to 500 million pre-money valuation. And if you're coming in at, I mean, even if you come in with a company that has 5 million in revenue, if you give it a 10x multiple for the pre-money valuation, so they're raising money on a 50 million pre. Yeah. If you get in at 50 million pre, to make a 10x return, you would have to exit at 500 million with zero financing between now and that exit. If you raise money from guys like you and me, we know so many VCs, you're going to raise at least 5 more rounds because we're going to introduce you and the
Right.
VCs are going to find you. So there's going to be minimum 10% issuance of stock in each one of those rounds. And so we're going to be diluted by 50%. So by the time the company actually has 5 million in revenue, you must exit for $1 billion plus to make a 10x return, which doesn't impress my wife or my twin boys. So it's like, what do you got to do to make a 35x return when you're investing in a company at a 225 million pre? You got to exit like bigger than Microsoft. So it's
Right.
just not going to happen. If you count the beans and say how many companies per year exit above 10 billion, and then how many companies get a Series A financing, their statistical probability of beating inflation is low.
And then we've had also just the proliferation of different, the B2B SaaS, million companies or like in bio and health, like there are 14,000 digital health companies. Okay, come on. That's not I don't even, you don't need to do any math to know, like, that's
How
not
many are
feasible.
funded? How many are funded
It was
to a certain
14,000
level?
funded.
Okay.
Like it was these numbers, but there was,
Over
but the point is, like, even that's not like you're going to see these discounted roll ups because I think so many of them in this case are, yeah, it's a fine product, but there's no business behind it. You can't build a business around this narrow of a scope. And I think it's one of the things that happened. I think I know in the digital health space where you just had these extraordinarily niche types of products. And it seemed like, well, this is the way we can go versus, okay, you actually need, more integrated and vertical type of things like, I'm going to take care of you from A to B. And so when we see that culling, I think you'll back to almost your Grim Reaper comment of we're going to see a lot of these companies get bought up for pennies on the dollar because it's there and you can get some side of exit, but not anything, nothing that the math will work out on kind of the thing you said. Now you may see that math work on the person who rolls them up and says, I've got now this offering, that offering, and so forth.
Well, I think the big changes in venture are funds have had a drift in size where they went from being early stage VCs delivering X and 5X returns to this little puppy here is getting out of control. So they went from making 3 and 5X returns to the fund being so big that they're investing at an entry point that's not very far from the exit point. If you're investing at a $1 billion pre-money valuation, it may only exit at 1.5 billion. And the other thing that's happened is that you have hedge funds that are publicly, people that invest in an IPO and invest after an IPO, and they get paid for holding the stock. I jokingly say hedge funds are a compensation plan masquerading as an asset class, but these guys just get paid for holding stock. I mean, I wish I could be reborn as them, but they have realized that if the company doesn't go public when it hits 200 million and it stays private forever, that they no longer get this bump at the IPO. And in fact, they're kind of missing out on owning OpenAI or whatever. So they cross over from public world into the private markets. And unlike a VC, most VCs, if your startup goes public and after the lockup of 6 months, you're under pressure to either distribute the stock or sell the stock and distribute cash. And these guys are coming into private markets and they're saying, oh, how much is the company issuing in this financing? And it's 10%. That if you give a company like 75 million and their last funding round was 15, they're like, I don't even need 75 million. But if you do give me 75 million, I'll put a lot of ads on Facebook and I'll automate some more stuff. So I'll increase average contract value and land and expand and then build out a sales team and get some new logos. I'll double revenue in a year if you give me 75 million. So I'm only selling 10% because the stock is cheap. So
Mhm.
now all the guys like you and me, we're letting our LPs double down directly with no economics to us, or we're doing SPVs. And so there becomes scarcity in how much of this 10% is available to that price insensitive hedge fund. And so they're saying like, all right, what's the multiple of revenue for this thing? It's got a billion in revenue. All right, the valuation's 10 billion. They're like, make it 20 billion so we get it. And then the other VC is like, well, if you make it 20 billion, that's like worth a lot more than this company would list for if it went public based on DCF and comps. Or if it emanate out now, it wouldn't sell for as much as 10 billion. So we need years to grow into that valuation. So the IRR is getting destroyed and the cash on cash multiple is probably losing money to inflation when you factor in the management fee that took 20% of the paid in capital out. So the big funds are getting all the money and they are making a multiple that doesn't justify the illiquidity of being tied up for so many years. That's my opinion. But it's a wonderful thing for small VCs because we can sell 10% of our shares in every round and deliver money faster than they can.
I don't know if it's kind of it's chicken and the egg. Is the maturing of the private secondary market, is that partially driving then, well, we can wait longer, early VCs can now get DPI from that market, or is it just been that there's been no other options, right? We've seen the lengthening of these companies staying private for longer, and the demand was like, I can't, can't hold for 20 years this kind of company, so we need something to get out, and the market matured in response.
Well, so we're sitting in a very interesting confluence of conditions, which I think are all fantastic for early stage VC. and wonderful compensation for those guys with, $6 billion funds. And it's amazing that they continue to get large allocators to fund them. What I think happened was, we had the .com era where you just change the name of your company to whatever .com and you go public. And then that turned out to be a house of cards and everybody lost their money. And so we had the .com crash. And after the .com crash, we were in nuclear winter, and it was the beginning of stay private forever. And then it
Mhm.
was the beginning of, hey man, my fund is hitting its, year 12 term. I need to exit this. And so we kind of got this robust secondary market where someone would buy shares in a privately held company that where they were investing, but the money didn't go into the treasury of the company to pay payroll and grow the company. It was into the pocket of somebody selling shares in the privately held company. And so Hans Swindlen at Industry Ventures, it makes total sense to me that Goldman would buy it because now they bought a seat at the table of what they were getting boxed out of if they were publicly traded guys, right? And there's a huge need for secondary market. If you also look at this is the confluence of conditions. Fund went from 50 million to 750. Fund went from 150 to 6 billion. That and then the company is only issuing 10% stock, and companies issue like 20. It used to be like you could see a company sell 40% stock, 45
Mhm.
in a rough situation in the 80s, in the 90s. But if the company's only issuing 10% stock and that inventory is getting scarce fast from early guys letting their LPs invest in that because they have a pro rata equity right to maintain their ownership percentage, that forces guys to cross over from primaries into secondaries. The first time Dick Kramlich at NEA raised $1 billion fund, he told me in a meeting that the LP said, Dick, how the hell is NEA going to invest in startups and return $1 billion? And he said, easy. All I need is to have 25% ownership at the time of exit of 4 unicorns, and le voila, there's your $1 billion. And to make your pretty head calm, I'll own 30%. Okay. Easily said, not so easily done when the companies are selling 10% stock at the point at which they show up with their how to deploy $1 billion or 800 million of dry powder in 24 months, that they were forced to do secondaries. So who are they going to buy from? The founder. The more money you give to a founder, the less she wants to sell the company an IPO. She likes being a CEO, and you might have a timeline of 12, 14-year fund, but she doesn't care, and she's got a big salary. She expenses everything. God knows everyone gets an Uber and a Michelin star sandwich at lunch. She doesn't want to sell. And the other one is to sell to buy preferred shares, not common shares, that's in the liquidation stack from early investors. So we've got an amazing point in history where you can do real venture capital and fund companies anywhere from pre-revenue to Series A. And these companies will raise much larger financings at huge upticks in valuation. So you're up 20x, you're up 8x, you're up 10x. Start selling 10% of your position, if not 50% of your position, to the mega fund and solve her problem that she's failing to get above 3% ownership. And she's promised somebody in France 30% ownership, the LP.
Mhm.
So this is a great time that we can return funds faster than they can. If your entry point was $1 billion and it's going to sell at 1.3 billion, you can't afford to sell shares to anybody with your uptick of nothing.
Right. Yeah. No, it goes back to the old adage of, fund size dictates strategy, right? And so okay, I want to steel man the big fund for a second. We are entering, I think, a new age of physical tech, AI. Like, this stuff is more expensive. I mean, you're seeing some of the numbers that we can argue the circular fund for a moment,
What you're
and put
saying,
that
capital
aside.
requirements for startups is going up?
So I think for the capital requirements for classes of startups is higher. So when you think about like defense tech, things you have to build physical things, all the robotic startups, the same thing. And then again, with the AI, like there's a reason NVIDIA is, just crossed 5 trillion. And so that it's funny, it's both. Some of the costs are going down. You're a pure play software company. No, those costs have gone down, right? You're able to use all these tools and so forth and be able to grow.
We're seeing
But
headcount go down.
right,
When I go through the financials of a startup, uh, which is our job, you're like, all right, what percentage was going to AWS hosting in the past as a percentage of total, OpEx and monthly expenses? It was like 15-20% max. And it's like, 80%, 75% payroll. Now we're seeing, payroll fall below 50%.
Hmm.
We're seeing compute go way up.
Yep.
But
Yeah.
I would argue that if you're looking for capital efficient startups to invest in the current AI boom we're in, they're there. If you want to invest in a data center and just be one of these guys, it's like drop a cable in the ground and get paid in the 90s. Well
So,
done.
well, yeah. So you can have.
Or if you're competing for the $1 million salaries or higher, then
So yeah, you have those competition. Like, I mean, obviously we're seeing with like Zuck and the ways, I'm taking founders and paying them $1.5 billion to come to the company. But at the same time, though, like if you are again these more building things in the physical world, I'm building rockets, I'm building robots, I'm building like it. I mean, I remember when Anduril Arsenal One was announced in Ohio, and it was $900 million they were putting into that. Like, it's not cheap to build a factory.
well, my response to that, Jason, is that some startups are capital intensive, like drug discovery and some hardware robotics type things. And one of the challenges for national security and like strategy for the United States or Western Europe is China became the manufacturing
Yeah.
factory of the world, and they were government subsidized and sovereign wealth fund in every single province and every single city. It's like the city of Nanjing, the government would invest in things that private markets would not. And so they did all things hardware, including automation of factories, where in the United States, guys like me were sitting in Silicon Valley saying hardware is hard. And I've been taught a lesson from the hardware investments we've made. And we've watched and experienced like a little change to the product means you've got to trash all the runs that have been produced and inventory. It's just like such a different thing, man. I've seen a lot of, I mean, we've made money in hardware. And whenever we did, I was like, holy cow, I just walked through Hamburger Hill naked in Vietnam and didn't die. Amazing, we got out, you know? Whereas in software and capital efficient things, you make a mistake, you can like send out a wireless service book and fix it.
Yeah.
Whereas if you drop a turbine into a river and something's not working, that's going to be punishingly expensive to fix and make a iterate lean startup change. So bottom line, some stuff is capital efficient and some stuff is capital intensive. And if everyone is ignoring, a sector like robotics and manufacturing, that's somebody else's opportunity to raise the money. The question is, can they make it work? And will there be a fund 2 or 3 or 4 if they're getting punished in there?
Two thoughts to that. So one, that's the kind of the statement is that because the capital intensive sectors are actually becoming a bigger part of the pie now than they were previously. Because we said, oh, it's fine, we can just move all that stuff to China, and then there's been a little bit of open realization of like, oh, well, you can make the coolest stuff in the world, and if you can't build it, ship it, or actually get it, use it, then what's the point? So one, you have that as a growing sector, and then also I think that we're having much more of a convergence of kind of the atoms and the bits world, because hardware, I mean, like I know on a Tesla, like, oh, great. So we get over the air updates every like week. And so there is and it does change the nature of the hardware. No, if like, okay, if the hardware itself, there's only so much that the software can fix, but it's iterating at a way now that you can update and change the hardware at a better
There,
pace than you could
there
before.
has been a renaissance in how hard hardware is. So hardware is hard, but hardware, like Flextronics and these kinds of companies have corporate venture capital business units that will encourage a startup to get into hardware, and they'll allow for a small run where, historically you'd have to manufacture 10,000 units, and you just can't manufacture fewer than 10,000 units.
Yeah.
Now, Flextronics will even give you the money and start making it for you and invest in you. And they'll end up being equity owners in it. 3D printing allows people to apply kind of software characteristic lean startup, experiment, iterate, measure, make small fine-tuned changes without the punishment of 10,000 factory roll runs. So I think there's been a renaissance in hardware that really came into being maybe 15 years ago.
Mm.
It's not like a we just had a chat GPT moment here. And there's behavior of, the likes of Flextronics that'll allow you to do that. So and then I think Elon Musk has made it cool. Elon Musk has made SpaceX and Tesla cool.
I think you're hitting on that something because I think we have had a slight. It's not quite the same as the ChatGPT moment, obviously, as that was as a technology that kind of blew the open. But I think from your point of the cool, like catching the rocket with the chopsticks had a story, a inspiration moment to really even more double down. I think this was going to say like, okay, we can do things that were just thought of as impossible before. And I think that's been more of the mental
I
part
also
of
think the other reality is that we had COVID where supply chains were in our face about, can the Chinese stop grandma from getting her meds? And you can't get electronics in a pickup truck if you order one now. The used car is worth more than the new one. Like, so there was that press release between Xi and Putin like 10 days before the invasion of Ukraine, of this limitless partnership between China and Russia.
it.
If Russia had sacked, Ukraine in 6 days as they had planned, then you would have seen an invasion of Taiwan happen like 10 minutes later,
Yeah.
and all the semis are there. But I think that we had a bit of a wake up moment with COVID, Ukraine, drone warfare, the idea of Terminator 2 drone robotic militaries, and these guys
It
all
shouldn't cost
manufacture.
a few $1 million or more, $50 million per missile to aim at one $10 drone. That math doesn't work.
Yeah, and also these guys can manufacture munitions better than we can because we hollowed out our manufacturing.
Yeah.
So I think that with the military situation in Ukraine and the prospect of things getting a bit contentious and nasty and Cold Warish between China and the rest of the world, and China being the factory of the world, that people have said, like Joe Lonsdale and Alex Moore had a 9/11 moment and made Palantir, you know?
Yep.
And and it used to be people refused to work in defense. Now dual use is a buzzword in every VC's deck. So I think that we've woken up to realizing we need nuclear power. We need energy to fuel the AI world, and we need to manufacture our own stuff and bring supply chains onshore. And the low cost arbitrage of labor in China has already drifted to Vietnam and Bangladesh and India and these other places.
Yeah.
And there's like a decoupling from China that's driving people to invest in funds that will fund hardware that historically was not getting funded at all by all the greedy, capital efficient people who want to, have it easier and have bigger returns. So you're going to see a lot of that come. And at the same time, we have this bit of an innovation. So you're going to see people raising funds that focus on manufacturing and energy and things that historically were not getting funded.
It's going to be interesting to see the nature of the kind of back to our first dynamic of these really large funds and the small funds and how that kind of comes into play. And you have like the, VC and Apollo coming together for different kinds of financing for these kind of reindustrialized movements. So whether it be hard tech, defense tech, whatever, because these are capital intensive things that require different economics.
I think the capital markets have changed. The capital markets used to be, you had venture capital was investing in early stage companies, and you get them up to a certain level of revenue and profitability. Like I remember after like after my IPO in 2001, we had Morgan Stanley as the lead underwriter, and we said, "So what are the new rules? Who can IPO now? What do you have to be to IPO?" And they said, 225 million top line, 6 consecutive quarters of profitability. And then I noticed like John Kraft IPO'd Pandora without 6 consecutive quarters of profitability. It was loss making like hell at the time. We saw all these loss making companies go public. So then the rules, you know, went towards greed again, which is good, if in my
Right.
opinion. Like I wish there were more IPOs. I kind of really miss the days of a company IPOing when it should. And I kind of don't love the capital markets that we've evolved into, but the new capital markets are what was venture is now like fidelity growth stuff. What's really dangerous about being in a real VC fund that is doing, post IPO growth financing is that they are co-investing alongside price insensitive long hedge fund people who just get paid for holding the stock. So someone's going to invest at a much higher valuation than it should be priced at because they're planning on investing in the IPO and even buying more stock after the IPO and getting paid for holding stock. Whereas that VC actually has to sell, you know? But this creates a huge opportunity for people to invest in VC funds that are going in earlier or starting that company that's getting funded by this new capital market flow where, you know, you get a big uptick, it makes up for the losses, and you can start quietly selling 10% or 25% in every round. And if the company is raising at a sick, crazy valuation in the multi billions and the unit economics are bad, this company may never be able to be profitable. You can just quietly be like, we're selling 100% of our position, at a Twix cash on cash multiple. My LPs are not going to hate me if we're leaving
Right.
money on the table. It's time to let them run this unprofitable business that's getting destroyed by too much funding.
So how do you think, I want to take it down from the VCs, but to like the founders, like how do you think of founders, navigating this environment?
Well, the other big change is that founders, the minute they get a secondary, they start, so they come into like 30 million in cash. They start going to YC demo day and investing in 15 companies before YC and at
Mhm.
YC. And then they all say, I want to be, I'm the founder turned VC. I used to say that because that's what I was. Like, we used to have it on our website. We're not idiot VCs. We're just like you. We understand all of your problems. They don't. We do. And founders could like feel it in the first 5 minutes of a meeting. They're like, you're so different than these other VCs. You're a real founder. I'm like, yeah, now that's everybody. We don't have that on our website anymore. Like YC, what are they doing? 200, 400, 400, 600 startups a year.
Something like
That
that. Yeah.
means that is like, let's go up 500. That's 500. There's two founders at each. That's 1,000 people, VCs waiting to hatch in 3, 5 years. And like the percentage of YC founders that are gonna be founders, VCs, is enormous. So Fred Wilson told me I was living in the Valley, but I opened our office in New York. We had 2 people full time working there every day, and he said, "You guys are one of 38 VCs in New York City with an office." And the joke was that I was like, "Yeah, you know what B2B and B2C meant after the dot-com crash? That meant back to banking and back to consulting you go." So, all the investment bankers, took the tie off and got a foosball table in Hell's Kitchen and said, we're VCs. And they all disappeared the minute the IPO window shut. But now I would argue there's like 1,200 VCs operating in New York City in the metro area. So it went from 38 to 1,200. And they're all founders turned VC or my LP turned VC or lawyer turned VC, you know, alumni from any big company where their RSU, stock options gave them money and they started just throwing it around. So to answer your question, what does it mean for a founder? What it means for the founder is that there's scarcity in inventory in their overpriced startup in the growth rounds
Mhm.
and these hedge funds and growth funds. And how do we deploy 3 billion in 24 months is you buy as much preferred as you can get your hands on, and then you cross over and start buying secondaries. And this is where, industry ventures, Hans, kind of innovated this a bit. I've been in his office like 17 times. We were doing secondaries with them where we were doing employee wide liquidity programs, you know? So the company's functionally publicly traded while it's
Right.
privately held, you know? So what does it mean for the founder? It means if you play your cards right, you can start selling some of your founder stock in the startup in advance of the startup crystallizing a liquidity event in the shape of M&A or IPO. And you can buy your mom a house and you can, you know, start buying lift tickets in Tahoe and you could hardly afford to go there on your startup salary before. And you can even start investing in startups and building your track record so that you can be that next YC CEO to become a VC. I've had multiple founders that I've funded launch 2 and 20 VC funds before the company exited.
There are very few people that can actually do more than one thing at a time.
They all say, yeah, yeah, they all say my partner does it. I just source the deals because I'm in such a deal stream and I know AI so damn well, you know.
Sounds like you don't believe him.
Well, it's concerning. It's concerning that, you know, we're funding the company. We would like them to say no to these other opportunities and be 100% laser focused.
Yeah.
And that's serving my needs. But, you know, it's a services business venture. Like, I'm sure, like, south of Rome, if you're a VC, you can just like dictate terms. And Austin used to be like that. Not anymore. If we're talking about Austin, you know, if you look at like Austin Ventures AV in the old days,
Hmm.
they could get away with murder, where it's like, thank you for flying American Airlines. We knew you had two other choices to get a nonstop flight from Austin to somewhere else. In Silicon Valley, it's like, thank you for raising money from 7BC Venture Capital. We knew you had 1,000 other choices, and we had to like impress you with our network and how we're going to help you, and that we're founders and we think like you. And it's like you're doing due diligence and seduction at the same time to get into that deal. AV would never do that in the old days.
It's an interesting observation I've had about kind of AV is you would normally think if, the 800-pound gorilla in something that doesn't have, as you said, your two other options, goes away, it's going to be a nuclear winter event for the region, and instead it was seemed to be a thousand flowers bloom. Like you obviously had a lot of kind of ones you can trace back to AV. A lot of those partners went on to do other things, but they also had a bunch of them. So it actually became the almost the positive catalyst event once they were kind of not taking up all the oxygen anymore.
Well, yeah. So I've known my first job out of undergrad tried getting me to move and relocate from New York to Austin. And
Mm,
then I ended up going to Silicon Valley instead. But I think that it used to be if you had a startup in Austin, you would go to California to get funding, and they would say, you know, you got to move your family to Palo Alto or San Francisco. Like, you got to move to the Bay Area because serendipity is just not going to happen. Like lightning strikes before and after lunch and during lunch here. You got to move here. And now, after COVID, so many people moved here. Jim Breyer, Joe Lonsdale, just so many VCs moved to Austin that it became the opposite. And you used to have the 30-minute rule that, you know, the startup has to be within 30 minutes of our primary residences, which are all in Menlo Park and or Woodside. So now that if the VCs move to Montana, he can't be talking 30 minutes anymore. And
right.
it's like a world of Zoom and a bit of travel. So live wherever the hell you want and travel and, you know, try to keep it in the United States and we should be fine. So now it's almost flipped that the VCs in the Valley are like, damn, we haven't even done anything in Austin. It's like the VC who, it's like, you know, VMware wants to acquire a company in Herzliya, Israel, so they can put a flag on the beach and start recruiting people there. So people want to invest in an Austin based company. And people realize California is pretty messy right now. I mean, it's getting a second life now, I think. But, you know, during COVID, people just wanted to get the hell out. And the pricing is so bad for housing that people are like, how are you supposed to build a company with thousands of employees and have them, you know, commute to the office in Tenderloin? It's just like, you know, X has always been in the Tenderloin. It's a nightmare.
Yeah, yeah. So we moved. You said we were talking before the thing in 2020. Our house in San Diego is almost doubled in price. It's not worth that. It's like insane. Like we
Yeah,
we
and they're
never could
also
afford.
really on top of each other. Like, you could spend a lot of money in La Jolla or any of these places. You know, during COVID, we were in Del Mar and Rancho Santa Fe. We're loving it down in Laguna Beach and all that. We're also everywhere up in like Napa and places. And then my wife, after doing like Airbnb the whole year, she's like, "Let's get out of the Bay Area. It's time
Mhm.
to go." You
Yeah,
know, but
and quite a few. But I do want to dive a little bit on Austin. So we saw, it's this kind of like tension. It's the 30-year overnight success. I do put that the kind of the 2018, 2019 to 2024. I think we're in a different wave now. Where like the heavyweights, like the people you mentioned, and Elon and Joe Rogan, and just Bill Gurley, etc., all moved to Austin. But it Austin had it wasn't the same as the groups that all went to Bozeman, Montana, right? They went to a hub that was obviously on the rise and had enough of an established thing so that when suddenly now you go from 3 firms to 50. Now, at the same time, it's not the Bay. It's not I personally have 50 funds that are my exact stage, my exact sector. It's like, no, you got that, and there still is something you have to go to New York and the Bay, I think, to raise. But I think the environment here has drastically changed, and right now, I mean, we're already when I just said it, it's 6.6 billion raised in Austin, which is a record for Austin, and we still got 2 months to go, and so we're going to
These
see.
numbers, yeah, these numbers are always really deceptive, though. Like, you see one company raises $1 billion,
Sure.
and I'd rather see you know many, 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 many companies raising 750K, 150, 350K, 1.5, 2.5, 5, 6, 12, 30 million. Like, it's almost like, show me all the show me how much money went into financings that were under 25 million, and show a lot of that.
So I think
Whereas, there's just six, one or two transactions that are humongous, and then that's the only number you're looking at, and that's how the media handles these things, and media, even like specialized media like PitchBook and Carta and all these guys.
I think you have it both. So one, we're seeing the general issue that, and this is in Austin, but in the Bay, right? Which is the total financing numbers, to your point, are going up, but the deal count is going down because it's being driven by the very high end. At the same time, I think one of the things is historically, I mean, Austin didn't have $1 billion deal, didn't have, I mean, to be in the top five, this year you had to raise over 200. We had 200, a 230, a 400, a
I mean, there's been
500 billion.
inflation. There's been inflation in valuations, and this is part of the stay private longer and stay
Yeah.
private forever phenomenon. Um, but I think Austin, we said like 30 years in the making. Uh, Austin was a huge hub long before there was COVID. I mean, and long before
Mhm.
Bill Gurley and Joe Rogan and everybody moved here. I think that like uh, was it you know
Dell and Trilogy and
well,
Tivoli.
IBM, to me, IBM was here long before Michael Dell started piecing together PCs in his dorm room at UT. That IBM made, Frank King ran IBM Austin, and he developed standard query language, SQL. So the internet wouldn't work without software that was developed in Austin, Texas. And you had like AMD has been here forever. So you had like this like semiconductor kernel level of engineering happening that was rivaling Intel.
I hate the term Silicon Hills, Silicon Slopes, Silicon, all the
Beach, yeah,
XYZs.
yeah, me too.
Yeah,
Silicon
but
Alley.
at least Austin actually has some claims to literal silicon with everything from
Oh,
MCC, AMD. There's at least some of that. I'm still going to do everything I can to kill that name, but
yeah. No one should say that. I mean, like if you're New York City, don't call yourself Silicon Alley. Don't compare yourself to like there's nowhere to get a drink after 9 o'clock. I mean,
I
and
think New
LA's
York
got good
got
looking
it.
people down there. I mean, they shouldn't call them Silicon Beach. It's like you're LA. You're the number two city in the whole country. Don't compare yourself to Oakland.
I I do think that like New York actually got it because there was a very short period of time that Silicon Alley was a term, and I feel like it died because I think you realized we're New York. We don't
You're
need to
just New York. Yeah, yeah, yeah.
yeah,
Drop
you don't
it,
need to
drop
be
it.
that
Yeah.
other thing, right?
Yeah, don't compare yourself to that little dwarf. It's just stupid. It's stupid. The Silicon Valley has a critical mass of kind of everything. The thing that's really impossible to replicate is big balance sheet buyers. Like you take your kid to a lacrosse game and you met the head of corp dev of, the company that's going to buy your startup.
Yeah.
And that's irreplaceable. I think it's important if you try to leave Silicon Valley like me, it's important to and leave New York like me, it's important that you are physically there all the time. Like I'm in
Mhm.
LA next week, you know, I'm gonna see we're gonna doing a whole week of events during Art Basel in Miami. That'll be, covered in Silicon Valley, New York, and everybody getting together. So I think it's important to travel. It's important to get in person, a lot. But the key thing about Austin is that Austin historically was very focused on enterprise. So this was enterprise software, this was enterprise technology like semiconductors. And I think with COVID, it was just like, well, all bets are off. It's no longer enterprise only, it's
Mm.
everything. even comedians moving here. Like people from everything is moving here. So it's no longer this like a spin out of IBM like Tivoli, and then it gets acquired by IBM. We're no longer dependent on IBM uh, to have a tech corridor in Austin. That's my view. And you're no longer required to move to the Valley as the CEO. They actually want you to stay here, and they like visiting. They like coming here for board meeting, and they're happy to know that your employees can find a somewhat affordable housing compared to um, you know, uh, the Bay Area or LA or Orange County or San Diego. Six of the most expensive top 10 cities in the United States are in California.
I believe that. And then
I mean, I think
probably New York,
it's
Miami, and a couple others. Yeah.
what's like San Francisco, Oakland, San Jose, LA, and San Diego. That's five. I don't know who I'm missing.
Probably another one of the smaller Bay Area companies, probably, or Bay Area cities would be my guess.
Yeah, I mean, you have like SF. I guess Berkeley is a city compared to Oakland. I don't know, but
I mean,
at
yeah,
any
you could
rate,
use, yeah,
when you think of like when they talk so much about these H-1B visas, I'm like, dude, if you make it really hard for us to give the H-1B visa, we're just going to hire the guy and he's going to stay living in Chennai, India, and he'll spend our every month, every 2 weeks, we'll be wiring US dollars out of the current account of this country and hiring that guy. It's sort of like the same kind of thinking. If you pay somebody $50,000 a year to live in India, that engineer can probably have a pretty damn good life. If you allow your engineer to move from the Bay Area to Austin, they probably have a better, standard of living on the same salary. And I
right.
think that Austin's become expensive. And if you're young and single and you want to live downtown, pretty damn expensive, and it's still not New York City. If you're young and single, um, so I think Austin's getting expensive, and people are starting to find their way to Houston and Dallas.
But it's funny you said it. So, like, your point on the Austin's getting expensive on a relative basis. So, like, if you're comparing it still to New York SF, like, it's not expensive. If you compare it to your point to Nashville or Houston, they're like, okay, then you have that kind of that disparity.
Nashville got
And
expensive compared to where it was.
yeah, but the difference also though is Nashville and Austin, like and Dallas and Houston, we actually build housing. So you've seen like the rents come down.
That's
You've
right.
seen this, and what's the interesting thing is you've seen there's also this tension between the city of Austin and the metro, because the metro is still able to give some of the outlet of, okay, it's going to be expensive to buy within the city limits of Austin, but if I can buy in Leander or Round Rock or something, it's still on that kind of relative basis. Now that
It's a little
can't
weird though.
be forever.
Like, normally, like the rules are the longer your train ride is from Tokyo, the cheaper your house gets. So, like every single stop as you get further away from like New York City, it should get cheaper unless you're moving to like East Hampton. But it's like theoretically, the longer the commute, the cheaper it is. Not always so in Texas. It's kind of weird. Like people want to live in these ranches in the middle of nowhere. I
Yeah,
find that
because you
like,
can have the space, you know?
yeah, but so Texas is weird that way. It can be very expensive and you're in the middle of nowhere, kind of place. But I think Texas and Florida have like a winning business model. Like growing up with the Cold War and the Soviets and the Americans, people are like, the United States has got the winning business model. I think that California has got a really broken model and people want to leave. And it's the greatest piece of real estate in the world. And it's tragic. And I just want to cry thinking about it. But like Texas has got a really winning business model. And so does Florida. So I think you're going to see monster growth in these two states.
We've seen it's not stopping anytime soon. I know we're coming up on a hard stop, but I always end with the same question: what's next, Austin?
Uh, I think I think that Austin suffered from Austin's growth of being boomtown, kind of like, when we came here as COVID migrants from California, suffered from the interest rates. So the interest rate situation is tough. That if you downsize and your monthly mortgage is higher, so I think there's been a little bit of a musical chairs. The music stopped on people buying and selling homes a little bit.
Mhm.
And so I think that stymied the exodus and the migration that was kind of underway. And then, you could argue that, Austin, Nashville, Miami, all these places, the housing prices doubled and then the interest rates went through the roof compared to ZERP. So I think if interest rates can come down, we're gonna see the current pick up a little bit, for Austin. But in the meantime, I think Austin is cool. I think that Austin went from we have to move to Silicon Valley or New York or Boston to get funded to no, 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 no. You can stay here and they want to invest in us here. That's good. I think that we went from every good startup was a spin out from IBM or some of these other kind of places. There was only a couple of big balance sheet buyers here. I think that now people are doing all kinds of things, from comedy to consumer startups, to anything. So I think that we've diversified from kind of just a small subset of sectors within the technology landscape to you can do anything here now. And there is talent here now. I wish we had a better airport. I wish we had more direct flights. That's been a shock for me. I've never lived anywhere where, I used to be able to get a direct flight to every city in China I never heard of. Now it's like, got to go to Houston or Dallas to get out of here.
The airport has been a common complaint, both and people I talk to and on the show. So we definitely need to fix that.
I mean, it's
Andrew,
okay. It's okay.
This has been great. I really appreciate you coming on the show.
Yeah, great to see you, man. Hope to see you soon in person.
So what's next, Austin? We're glad you've joined us on this journey. Please subscribe at your favorite podcast catcher, leave us a review, and let your colleagues know about us. This will help us grow the podcast and continue bringing you unique interviews and insights. Thanks again for listening, and see you soon.